Hey everybody, Mason Buckles here. It is Monday, the 26th of August. I can't believe summer is almost over here in Seattle. I'm hoping for that late summer that we get in September just because I'm not ready for those gray skies and not 75 to 80 degree weather yet. However, here are the three things you can use this week ahead of a holiday weekend. First and foremost, busy week last week from the Fed. They had their Jackson Hole Symposium, which those that know leaders of a number of central banks around the world met in Jackson Hole to discuss the current global and national economic status, policy, and trend, and what will come out of that. And what we saw was really some nicely dovish remarks from Chairman Powell on Friday. For all intents and purposes, the 25 basis point cut in September has been baked into the market. But now the question becomes, will there be a bigger cut in September, or are we going to wait till the Q4 of 2024 to see these cuts really kick in? The prevailing sentiment from a market standpoint is up to 100 basis points of cut here by the end of the year, and a total of potentially 225 basis points, so 2.25% in total cuts over the next 12 months. That is very exciting when you think about it from a mortgage perspective, because historically, mortgage interest rates tether at about 1.75% above the Fed funds rate. So, what does that mean? Really simply, the Fed funds has been stuck at 5 to 5.25 for the last year plus, and that's what's kept those interest rates right around 7%. And now we're starting to see a shift in mortgage rates where they've moved down nicely, even again this week, seeing them come down a little bit compared to just last week. And ultimately, as the Fed starts to drop their rate further, you can expect mortgage rates to come down with that. So let's do some quick math here. If rates are at 5 to 5.25 on the Fed funds, and that makes your mortgage rate 7%. 1% on your Fed funds rate, so call it 4 to 4.25, should bring rates down nicely to about 6% on a mortgage. And then if you dip that all the way down another 1 to 1.25%, which is the current sentiment and forecast from investors, that puts that Fed funds somewhere around 3% plus or minus, and your mortgage rate's somewhere right around 5% over the next 12 to 14 months. So exciting times when you start to think about what that means for housing and really kind of bringing that market back into more of an affordable standpoint for buyers. Going to share with you a couple of articles here as well, but first let's talk about where rates are. So again, conventional 30-year fixed rate mortgages dropped another about 10 basis points to an average of 6.43% this week, looking at today's data. That puts your 15-year just below 6%. You've got your jumbo loans somewhere in the mid 6.5% range. We are locking a little bit lower on that on jumbo and on conventional for that matter. FHA and VA or government loans nicely into the fives. I will say there is probably still some buy down being accounted for in these quotes, so something just being mindful of if you're talking to your clients about rates. I would always encourage you just to let us do that, but if you want to, just remind them that still buying some points or some minor points is something we're seeing still relatively prevalent in the marketplace. Thinking about what's to come, so I shared a couple of articles today that might be worthy of sharing with your clientele if you see fit. One just talks about the Dow. Right, it's been a wild ride over the last month in the stock market. Again, we just closed out today here Monday at a new record high yet again, but it talks about what are the shifting focuses. And as the Fed really starts to lean into their policy change, what does that mean for stocks, and where should we be, potentially focusing our attention as well as being cautious? So something just to keep in mind of as you're looking at that. And then I talked about how that correlates to the housing market. So looking at really some predictions for housing over the next year and a half or so. Prevailing sentiment, again, is that mortgage rates will drop. The catch-22 is, what does that mean for inventory? Because what we've seen is inventory climb over the last couple of years as rates have been higher. Certainly, there is a case to be made for sellers coming out of the woodworks as their interest rates start to come down and they feel more comfortable. If I'm at 3% and rates are at 5, it's not as big of a jump going from like a 3 to a 7, for example. There was a lot of surveying done over the last year and a half that had 6% as the magic number that both buyers and sellers are targeting. So I'll be curious to see what that means as we start to approach that here over the next, call it 3 to 6 months. Last but not least, it is a holiday weekend, so keep a lookout. I shared a link here, but there is a ton of activities to partake in here in the greater Seattle area and Washington as a whole. A number of fairs. You've got the Evergreen State Fair, the Washington State Fair, the Kitsap Blues Festival, Dave Matthews is a staple out at the Gorge over Labor Day, and then you've got Bumbershoot here locally. So lots of cool things to check out from kind of an arts and entertainment standpoint. That link shares a lot of different things that you can go do, both family friendly and not. So check it out. Have a great, great end of the summer. I know school starts, at least for my family, here on next Tuesday. Ready to get back into that normal routine, but we are going to miss those summer days. Hope you're having a great week. Look forward to chatting with you soon. Take care.